SquawkBox.com.
Okay, welcome back to Squawk Box right here on CNBC. We're just a couple of minutes, we're 1 minute away from the government's March employment report. Ahead of that data, we want to show off our jobs panel. We're going to be speaking today with Netta Issa, Associate Professor of Public Policy and Economics at Georgetown University, Stephanie Kelton, who is Professor of Economics and Public Policy at Stony Brook University, Stephanie Link, who is Chief Investment Strategist and Portfolio Manager at Hightower Advisors and a CNBC contributor. And, of course, we've got our own Steve Leisman and Rick Santelli, who are standing by. Let's take a look very quickly at what's been happening with the futures ahead of this, just so we can see any reaction that may pop up. Dow futures up by about 100 points ahead of this number. You've got the S&P up by 20, the NASDAQ up by 73. And then if you've been watching what's been happening with the treasuries today, very quickly take a look at those yields, too. They've been a little higher. I think the 10-year was at 4.33. 432 right now. The 2 years at 466. Again, the number that we're watching for is 200,000. That would compare with the 275,000 from last month. Unemployment number, 3.8%. And we're going to hand it right over to Rick Santelli.
Yes, the big March jobs report hitting the wires. Non-farm payrolls, a whopping 303,000. That most estimate, and goes right along with the whisper number, which was higher than the estimates due to the strength in ADP. 303,000, that's the juiciest number that we've had going back to 303,000 equals May of 23, right on the nose. To find a higher number, you go back to January of last year. If we look at the unemployment rate, 3.8. Now, this is a biggie because last month's 3.9 was the highest unemployment rate since Jan of 22. So it did moderate just a bit. If we look at average hourly earnings, which were up 0.1% last month, that was the lowest month-over-month change since March of 21. Let's call it 3 years. First of all, that was revised now to up 0.2, and the new number is up 0.3%, exactly as expected. Year over year, 4.1, as expected. Down from 4.3. Actually, when you look at 4.1, you have to go back to June of 21. June of 21, 4.1, June of 21, and find a lower number. That's a really big deal when you consider what the average hourly earnings on a year-over-year basis have been doing. Average work week, 34.4 hours. That's a 10th higher than we were expecting, and a 10th higher than the rearview mirror, which was 34.3. And finally, U6. That's the underemployment rate, 7.3%, and labor force participation, wow, 62.7. 62.7. That is a nice jump. We were at 62.5 last month, and 62.6 was expected. So these numbers are definitely stronger than expected, and one would expect rates to be higher, and indeed they are. 470 now, 470. So we're up about 5 basis points in a 2-year, and the 10-year was right around 432 before the number. It's now 437, so it's up 5. And I can't stress enough, any yield close in 10s above 433 on a weekly basis should keep momentum to the downside in price and the upside in yield. And many were looking for the unemployment rate to move higher than that 3.9. The fact that it backed up a bit is very important. And there's been much written about the number of weekend days in February versus March. A lot of issues there. But all in all, it certainly does seem like the numbers are better than expected. And, in my opinion, probably make the Fed's decision that much more complicated. Becky, back to you.
Yeah, in your opinion, and it looks like in the market's opinion, too, the 10-year's now at 439, so that's an increase of about 6 basis points from where we started when we got this number just 3 minutes ago. Rick, stay right there. Let's bring in the rest of our jobs panel on this for some instant reaction. Steve, let's start with you. Dig through the numbers. Tell us where those jobs actually were occurring. 303,000 versus the 200,000 that was the estimate.
Okay, so I was just able to calculate on the fly. Did not double-check my numbers, but... Okay, I had a calculator here. 68% of the jobs coming from 3 sectors, if I'm not mistaken here.
Okay.
You can guess what they are, Becky, I bet.
Restaurants, maybe? Leisure?
Leisure hospitality, that's 49.
Government?
Government's 71. That's 2 for 2. I'm going to call you a winner because you got 2 out of 3.
Yeah, tell me, what's the third?
Which ain't bad, according to some song. And
no, I'm not going to get the third.
Oh, education, and health services.
Yeah.
Right.
Those have been the 3. 68%, 203,000, I think, or 200-something thousand came from those 3 sectors. I'm not seeing a lot of strength outside of those 3 sectors here. This is the test right now, folks. You are being tested in the market of this theory that the headline number doesn't matter as much as the inflationary indicators inside. Now, the payroll was a little bit hot. The reason why the year-over-year comes down is you have some bigger numbers dropping out of the calculation from prior. There were 0.4, 0.5s in the rearview mirror. Those are dropping out. And you replace it with a 0.35, I think, if I'm not mistaken, was a little on the high side, but still your year-over-year comes down. But the big story of the day may be the participation rate. Technically, theoretically, as long as the labor force is increasing in size and you have bodies to fill jobs without creating stress and needing to bid up wages quite so much, that is not an inflationary development. It's okay to put as many people to work as want to come to work at a wage that is not greater than the sum of, as we talked about in the last hour, inflation plus productivity. I'll leave it there because there may be people on the who disagree with me.
Just to dig into that a little bit, the idea that we are bringing more people back into the workforce, this is what we've been waiting for since the COVID pandemic broke out. The idea, are you going to get these bodies back into the workforce? Did they run out of savings? Did they get forced to be brought back? Are they looking at better job opportunities than they had seen before?
I think all of the above. You can't know it. Like you can have your glass half empty and say, people are only going to work because they need the jobs. Well, when did jobs become a welfare program? It's not. Jobs are being offered and paid for because employers have work for people to do.
But if you have run down your savings,
if you have, you may want to come back.
If you had excess savings, as the American public did during COVID, from a lot of government handouts that came out from other places that they were saving from maybe money they weren't spending because they weren't traveling.
Or what if you can work from home and do 2 jobs from home now that you could only do 1 before because you were spending time commuting? Or what if you were on the sidelines? What if
moonlighting writ large? Okay.
Well, no. What if you were on the sidelines as a retiree and somebody said, you know
That's
what?
I mean. If you get
I'll give you $40 to come back to work, and before that it wasn't worth it. And then there's the other side of this thing. So there's no way to know is it one or the other. One thing I could look at is what the participation rate is of seniors or older folks.
That's what
are they coming back into the workforce? But more than just waiting to get back to the pandemic level, we have exceeded the pandemic level. We have brought more people back into the workforce.
Hold on a minute, folks.
Don't
get too excited, though. We had
I'm very excited, Rick. Don't tell me not to be excited. 3 readings last year
that were 62.8. 3 readings last year at 62.8. We had it in November, we had it in September, we had it in August last year. So even though it's important and it's jumped from 62.5, it's not like we haven't been there and done that rather
Yeah, and
recently.
we're still below. You're right, Rick. Rick, I could see that point. We're still about a half a point below where we were, although I got to look at the prime age number, which I'll look at in a second, but that, I think, had already exceeded it. But we have this issue of seniors actually having dropped out of the workforce, and there's a weird situation of them not coming back, and that's part of the reason.
Okay, we invited all these guests. Let's have them jump in here, too. Netta, let's start with you. Your reaction to the numbers, your reaction to what you think this means for the Fed.
So this is a surprisingly large number. I think that the analysis so far is pretty accurate. This is doesn't look to be, it's a very large number, but it doesn't look to be inflationary because we're somehow getting these jobs filled. I think the story that we haven't talked about that seems to be lingering in the background is whether immigration is playing a role in filling some of these jobs. And as long as that's happening, I think we're going to be okay. I don't think the Fed has enough yet to make decisions about whether to cut rates. I think we still have to hold on. And I'll note one other thing, that we had a very strong jobs number 2 months ago that we revised down. So we have to be a little bit careful about reading too much into 1 month's jobs number.
Stephanie Kelton, let's get your take on this, and then we're going to weigh in with Stephanie Link on the market reaction. But Stephanie Kelton, your thoughts on this?
Yeah, this is an economy that's being powered by 2 things, fiscal policy and net immigration. And, I think it's really important that we do pay attention to that last part of this. Last year, half of the growth in the labor force came from net immigration. There were 5.2 million additional jobs last year thanks to net immigration. And it's been the key to rebalancing the labor market. It's a huge part of the reason why we've got the growth that we've got and the disinflation that we've had. So, I mean, this is an eye-popping number. I think that the story it tells is that we should be expecting the Fed to follow through on that promise of higher for longer. I don't think it makes a whole lot of sense to think in terms of 3 and probably not even 2 rate cuts this year.
Becky, real quick,
yeah,
I am correct. 25 to 54 prime age workforce participation is up 0.5 point from pre-pandemic. Rick is correct. The overall is down 0.5 point.
Down.
I think seniors are the swing factor there.
Okay.
So nice when both Rick and I are right.
Wow.
Doesn't happen often.
Stephanie Link, we're watching the market. We were looking at the Dow Industrials indicated up by 100 points when we started. Now it has given back. Actually, let's show me the futures again. Okay, Dow futures still indicated up by about 65 points, but clearly you did see the move in Treasury yields that adds a little skepticism to the idea that you're going to get a rate cut anytime soon.
Yeah, we're probably not getting a rate cut anytime soon. At the end of the day, though, this was a good number. We have a really good economy, 2.5% GDP. That's what we're running at right now. And that's on top of all the momentum that we saw last year. And it's led by the consumer. And I think we were all a little bit nervous about average hourly earnings, maybe that coming in a little hot after the ADP report, but it was right in line. But it's also very supportive of the consumer continuing to spend. And Steve mentioned that leisure and hospitality led the way. So we root for the consumer because it's 70% of our economy. We root for services because that's 75% of consumption. So it's all going in the right direction. It's continuing on the momentum from last year. All of this means earnings can continue to be good. Double-digit earnings growth in the fourth quarter. I think you're going to see 8 to 10% this year. These numbers are very supportive of that. And so the other interesting part is we're seeing a broadening out of the marketplace. There are places to actually put money to work and on the dips like yesterday. And I think a lot of that yesterday was because oil prices rose above $90 a barrel on Brent. Watch oil prices. That's a big deal. But the broadening out is very supportive for a market that is probably going higher, edging higher.
You're a buyer on this number.
I'm a buyer on this number, absolutely. But I'm not a buyer so much on the Mag 7 and tech. I'm looking more at energy, industrials, financials. I think earnings are going to come in really good in those sectors.
Becky, we went into this number with a probability of a June cut at 65% to underscore what Stephanie just said. Now down to 57, not as low as the contract has been on a probability basis.
Yeah, it was below 50.
And then sort of going on with what other was saying, but we not to get a rate cut anytime soon. July actually also dropped. I don't like looking that far out into the universe here, but it's dropped. And based on one number, but it's dropped down to 74%. So I like to say a number is more in play and when it has a 60s in front of it, but they're still feeling pretty good about July, but not so good about June.
Stephanie Kelton, very quickly before you go, we were with Michelle Girard earlier, and she pointed out that there's a CPI number coming next week that may be more important on this. I'm sorry, CPI number coming next week that might be more important. What do you need to see there?
Well, we'd like to see continued progress. I think, this idea that we've got a couple of bumps in the road, January, February, would be really nice not to have another bump in March, or it starts to look like more of a hill than a couple of bumps in the road. So we would very much like to see the wage pressure give us indication that labor market is accommodating new entrants without much pressure on wages. Productivity growth is there doing its thing, and we'd like to see that number come in line with expectations and no downside surprise.
All right, want to thank our panel this morning, Netta, Stephanie Link, Stephanie Kelton, Rick, and Steve. We'll see you guys later.
Okay, coming up after this, a look at how the Fed may take the latest jobs number into account when it is time to decide on interest rates, as we've just been debating. Former St. Louis Fed President Jim Bullard is going to join us in just a little bit. Stay tuned to hear his perspective on all of these numbers and what it means for the Fed's next big decision right after this.
So okay, that we have the numbers for the jobs is way too high. Of course, inflation am I gonna pick up a little bit? I don't know, because a lot of people working, more people working more. People, spend the money. Of course, they looking at the what they call the salary. So I think the salary didn't go as far as I think keep the same number. I think 4.8%. So that was our cover for the morning job salaries for March. I mean, sorry, open jobs. And right now we have SPY going up 515. But it was big pressure for the bears. Let's take a look at just a second. DIA we have 387. Actually 387 was the high. No, pre-market 387. It's up 0.38%. So that's it, guys. Thanks for watching, and see you tonight.